Andrew, thank you for joining us. Here we are then, start of the new year, and a good chance to look back at the previous 12 months. Let's start with markets if we may. How did markets perform in 2014?
Okay, 2014 was a reasonably good year in markets, despite plenty of reasons for investors to be fearful and a healthy increase in volatility during the course of the year. Developed market equities posted single-digit returns in local currency terms. The US market was a standout performer, gaining around 13%, whilst the UK market posted a small return of just below 1%.
Yeah.
The main laggard was emerging market equities, falling around 2% or so in dollar terms. Fixed income markets were the big surprise for the year, with great returns. The UK and European government bond indices posted returns of around 15% in local currency terms, a phenomenal return that very few investors would have expected at the start of the year. And the US Treasury market gained around 6% or so, which in itself was a decent return, especially when a year when the quantitative easing program in the US was coming to an end and interest rate expectations were increasing. This backdrop led to significant US dollar strength against other major currencies. The dollar strengthened by around 6 to 12%, which has significant implications for returns when measured in dollar terms. For example, European equities in dollar terms were actually down for the year, but conversely, US equities in euro terms was a very high return. In terms of other asset classes, the only real area that saw a lot of pressure over the year and posted negative returns in local currency terms was commodity markets.
Yeah.
And of course, oil was a key component of that. The fall in the oil price had and continues to have significant knock-on effects across markets.
No, absolutely. Against that backdrop then, Andrew, how did the Harmony portfolios fare?
The Harmony funds fared reasonably well over the course of the year, posting decent returns. We perhaps could have performed slightly better in that there were some missed opportunities.
Yes.
At the start of the year, we expected interest rates to remain low. We didn't expect them to fall to the extent that they did. That corresponded with good returns as yields fall and prices increase. So although we had some exposure to that, we could have had more and had better returns. But in the event, it was a decent year. So specifically, the Australian dollar and euro funds gained 6% in local currency terms. The US and sterling funds gained between 2 and 4%, depending on the profile, with growth outperforming balanced.
Yeah.
Whilst the Asian funds were more of a laggard with low single-digit gains in dollar terms. They were held back by the underperformance of emerging market equities, which form a large component of those funds, as well as muted returns from Asian bond markets over the period. If you compare performance to the local equity index for the respective funds, that compares reasonably favourably for the year. In the UK, the sterling funds outperformed the UK market, whilst the Australian and Euro funds were only marginally behind their respective equity index, but with much less volatility. So we feel that was a reasonably good outcome there. And explaining that is really the inherent diversification that's built into the Harmony funds in terms of each of the funds has got around about a third outside of their home region in global investments, and around 20 to 40%, depending on the profile, in fixed income markets. So those factors really helped in a year when the US market outperformed, the US dollar was strong, and when fixed income markets performed well.
Thinking about the third-party specialists you employ in the funds, how did your managers perform in 2014?
Okay, so the impact of asset allocation versus manager selection and the contribution to returns is going to vary from year to year. 2014 was very much a year where asset allocation drove returns and manager selection had less of an impact on the overall outcome for the year. It's worth noting that 2014 really will go down as a difficult year for active equity managers. Most struggled versus their benchmarks, particularly global mandates and US mandates, and that was really driven by the underperformance of small and mid caps. Most active managers have a bias towards that area, as well as the significant outperformance of the US market and the US dollar. that made it difficult for active managers. But nonetheless, amongst our holdings within the Harmony funds, the aggregate of our global managers performed reasonably well, more or less in line with benchmark, whilst the US side of things did struggle a little bit versus benchmark, with all of our managers underperforming, but all but one of them still posted double-digit gains. So not a bad year in that respect. Our regional equity manager selection was good and contributed to returns, particularly in the UK and also in Asia as well. In fact, in Asia, two of our holdings there, the Pacific Asian Income Fund and the Pacific Assets Trust, gained around 16% in dollar terms, which makes them the best performing holdings across all our funds, with the backdrop of Asian equity markets being one of the worst performers.
Absolutely. What were the key decisions you made in 2014?
Okay, we were reasonably active in our asset allocation over the course of the year. In terms of key decisions, we reduced our fixed income holdings further. We were already at relatively low levels, but as yields fell, we reduced further and actually sold out entirely from our investment grade and high yield holdings across all of the funds. Valuations just looked too unattractive to us. Specifically, we felt that there's much more downside risk than there was upside potential. And also, with valuations where they are, these fixed income holdings provided less of a diversification benefit alongside our equity holdings within the funds. However, speaking to the volatility I mentioned, high yield started the year expensive. It got more expensive with yields falling below 3.5%, but then sold off quite significantly from the middle of the year, and by the end of the year, yields were back above 5%, which is much more attractive from our point of view. So we actually re-entered the high yield market towards the end of the year on the short duration side of things, where there's less interest rate sensitivity for the time being. But so that was an example of an area where we've been particularly active, and we may further increase our exposure into 2015. Elsewhere, again on valuation reasons, we slightly trimmed our listed property and listed infrastructure holdings. They gained over 10% in dollar terms over the course of the year, a great contributor to returns, but looking slightly less attractive at these levels. On the other side of things, we have been buying equity exposure in developed markets opportunistically. For example, Japan in the middle of the year and the UK later in the year as opportunities presented themselves during market corrections. And also we've been increasing our emerging market exposure across a range of different asset classes: emerging market equity, corporate bonds, sovereign bonds, convertible bonds. We see very attractive valuations in all of those areas. So we've been increasing our exposure in as diversified a way as possible, but still mindful of not introducing too much of our risk budget in emerging markets.
Okay, as we look forward then to 2015 to come, where are the Harmony portfolios positioned as of today?
Okay, so compared to our strategic asset allocation, we've got a mild overweight towards equity markets and a underweight to fixed income markets. But the main differences, I suppose, are within the mix within there. We continue to have best of breed specialists within all of those asset classes, and we focus on those areas of equity, fixed income, property, whatever markets, those subsections within there where valuations look most attractive. But overall, we have a mild overweight to equity, and that really is a function of our view that valuations are attractive. They're not cheap, but they look reasonable. The economic backdrop is supportive in terms of good economic growth coming through or supportive monetary policy, and corporates are in good health with solid balance sheets. So we feel there's potential for moderate returns from equities going forward, and are positioned accordingly.
Andrew, thank you very much.